I'd like to welcome everyone to the New York Alternative Investment Roundtable call for November 17th, 2021. I'm Robert Atkinson of the Riverside Management Group, the moderator. Today, we are very pleased to welcome two dynamic leaders in the credit space, portfolio managers Denise Crowley of Zeiss Capital and Michael Haynes of Beach Point Capital Management. The title of their talk today is Current Trends in the Credit Market and Their Broader Implications. I think it's no secret to anyone on this call that while favorable conditions have existed throughout most of 2021, major uncertainties stand before us, including those related to the virus, economics such as rate increases, and rising geopolitical tensions, which could include US-China relations, global migration, and of course, climate change. So because of these and other factors, what might the credit markets have in store for us in 2022? Will current inflation concerns prove to be transitory? What will economic growth look like? How will consumer health and strength, lending demand, changing terms and products be impacted by all this? What about the impact on commercial real estate market trends? How might relative value among asset classes be affected by all this, et cetera? So these are the questions that our guests will weigh in on today. Let's begin by asking each speaker to succinctly tell us about your firms, okay? So I'm gonna ask Denise of Zeiss Group to take us out. Okay, Denise, can you give us a few words about Zeiss?
Yeah, certainly. Thanks so much, Robert, for having me today. Zeiss is an asset management firm focused mainly on alternative credit. We've been in business for 24 years. I've been with Zeiss Group since its inception. It was founded by Christian Zugel, who remains our CIO today. Christian, prior to founding Zeiss Group, ran JP Morgan's high yield sales, trading, and research business. I worked for Christian there at JP Morgan. And really the impetus for starting this business so long ago was to be able to capitalize on dislocations within the credit markets, predominantly alternative credit markets, to the benefit of our investors. And that's, really sort of a mentality that we've maintained for upwards of 24 years now. And that has brought us into many different segments of the alternative credit markets. Originally, our business was mostly focused on what I would sort of call corporate credit-backed structured product. That was everything from high yield CBOs, CLOs, and synthetic structures as well, through to various loan and bond alternative structures. And then over the years, it morphed into, taking a broader look at other parts of credit, things like the consumer lending space, real estate, and so forth. And, we've gone through many different cycles over the last 24 years, and I think we've come through all of those learning something. And I believe that our core beliefs really haven't changed over that time. We really do seek to do deep credit, fundamental, as well as technical analyses on various segments of the market. We try to have pretty diverse portfolios in terms of the underlying risks to which we're exposed. And we try not to use too much financial leverage, because we have seen time and time again that tends to not work out so well during periods of stress. So that's really our background. That's where we come from, and I think we have developed the business into a pretty broad business today. We have approximately $7 billion of assets under management. We have a CLO business through which we issue CLOs, and we have fundamental credit analysts that do research for us and collateralize those deals with leverage loans. And then we also have a team that really focuses more broadly on structured credit investments, everything from third-party CLOs to asset-backed securities, lending facilities and loans, commercial real estate, and loans and securities, and similarly on the resi side, everything from loans through securities. So that's where our business stands today. We continue to find this market exciting and some interesting opportunities, and happy to share some of those with you today.
And we look forward to hearing more from you, Denise Crowley. Thank you very much. And Michael Haynes of Beach Point, tell us about your firm, please.
Sure. First off, thanks for having me. Also on your note about the first live event, I don't know about anyone else, but if it's all the same, I'd prefer all of these be in person going forward. So glad to hear someone's, breaking the ice for all of us. So congratulations.
Yes.
Not that I'm not happy to be here, happy to be here on Zoom today and all of that. Beach Point. So Beach Point manages about $17 billion today, largely for US public pension plans, some in Western Europe as well. We run series of commingled funds as well as separately managed accounts for larger clients. And those commingled funds go from all the way from your sort of traditional hedge fund structure to drawdown funds and funds that look much more like private equity funds. So we sort of cover the gamut, both as relates to the type of products we make available to investors, but also to the types of markets we cover. I view Beach Point very much as a multi-strat investment management firm. We, in our 30-year history, have developed a business that is quite flexible in terms of the market opportunities we evaluate. We have capabilities all the way from sort of traditional high yield and leverage loans, all the way through to deep distressed expertise appropriate for some market cycles, and structured products as well. And then as relates to the types of opportunities we look at, we are constantly evaluating public markets and private markets, and really for many of our strategies, just sort of looking for the absolute best relative value. And the depth of the skill sets we have allows us to sort of navigate between those and seek where we think the best risk reward is. If there are some commonality as to what we do, it's one, we are very much of a fundamental research firm. Every credit investment we make is picked over from the ground up. It would be no exaggeration to say someone at Beach Point has read pretty much every word of every document related to the credit investments that we make. Credit's a bit different from equity in many respects, but largely definitionally speaking, when you invest in credit, you buy a stack of paper, and that stack of paper entitles you to rights and remedies and a coupon and a repayment at some date in the future. And so the context for that documentation and its strength and an ability to analyze its strengths and weaknesses is critical to what we do. To that end, a big part of our investment team are former bankruptcy attorneys and legally trained, and we put an extraordinary amount of resources into evaluating all of the legal both issues and opportunities embedded in the investments that we make. And then lastly, as relates to which industries or markets we're pursuing, it's largely the same answer. We have a key corporate credit capability across a ton of industries, and most of our analysts have been covering those industries for decades. Some of them, like myself, have actually worked within companies and bring somewhat of a operational aspect to our analysis when that's appropriate. We have a capability in real estate where we have a dedicated team, in structured products and CLO secondary markets, and a dedicated distress team. And so we like to think that we give our clients a great opportunity to sort of allow us to navigate between those opportunity sets wherever those situations may arise. We've outperformed the high yield market for as long as I can remember, and I think have provided a great reward to investors who backed us. And if any of them are on the phone, we thank you for your support. And like Denise, I'd say I'd agree, despite what you might read on the front page of the Wall Street Journal about how tight the credit markets are, that applies to some, but not all of them. And we're sort of as busy as we've ever been looking at new opportunities and deploying capital on behalf of our clients.
Well, Michael Haynes of Beach Point, that's terrific. And thank you for joining us. And Michael, I'm going to hit you with the first question. So how do you find navigating current market opportunities here in, let's say, November of 21 versus what you experienced back, let's say, in March, April of 20, when COVID really began to hit its stride. What are the differences that you're seeing, Michael?
Wow, I mean, we only have an hour, so I'll try and condense it as much as I can.
Come on, I know you can do it.
Yeah, first, everyone knows what happened in March and April. So let's just touch on what that meant from the point of view of a financial markets investor. It
Yes.
meant you were looking at an environment you had never seen before, with data points that you didn't understand and no research to tell you where it was going or how it was going to wind up. And
Okay.
so correctly, that was a public market, target-rich environment with irrational selling and panic. And if you're a distressed investor, that's what you live for. And not surprisingly, in March, April, and May of 2020, Beach Point deployed more capital per month than we had in the history of our firm. Not because we had any better answer about the pandemic, but only because we were willing to invest at the top of the capital structure in great companies and assets at substantial discounts to par, and took the view that we were happy to, restructure those assets or companies or own them to maturity without any specific view as how they'd play out, other than to know this was sort of a once in a career opportunity in terms of the basis upon which we were able to create those underlying companies. And so our bar for investing was extraordinarily high in terms of the quality of business we were targeting, at the same time buying, first lien term loans at prices that, were just not traditionally available, even in more modest cycles. So
Okay.
as the year went on, data points were aggregated, the economy's reaction to the pandemic became more clear, the path to recovery became more clear, politics in a sense became more clear. And so, that was a year of filling in the gaps of information and perspective. And not surprisingly, we and others got more comfortable, and all asset classes appreciated substantially from their lows. And so I'll fast forward to today. Today, it's entirely different. There are all sorts of stresses, much like there were in March and April. They're just different stresses. The stresses today relate to inflation. They relate to logistics issues, many of the things that I'm sure all of us have read about it. But they're affecting a smaller cross section of the market. And at the same time, the backdrop for liquid financial markets is different. High yields at sort of historically low levels from a yield perspective, largely being a rate-driven phenomenon. And we can all look at equities performances, and those are extraordinary. So, despite there being many stresses in the economy, a vast majority of the market is not really experiencing, from a price perspective, any of those stresses. Where we are seeing those stresses are in private market opportunities and things that are not tradable. And so over the last 12 months, the investment team at Beach Point has, made a pretty substantial pivot to how we were spending our time from the biggest, most liquid distressed names in March and April of 2020 to really idiosyncratic, unique opportunities in affected industries in the fall and winter of 2021.
So just a quick follow-up on that, Michael. Are there any sectors in particular, or is this, as you said, completely idiosyncratic?
Many of them are, but there are some commonalities. Many portions of the leisure and hospitality sector are still facing substantial headwinds. Different headwinds. It's not demand anymore. It's cost and it's labor. And it's sort of the path of the recovery. It's really not like, is anyone going to want to go to hotels anymore? I think many of those issues have been addressed. But there are parts of the economy that are suffering from an inability to hire, and frankly, from increasing debt levels for liquidity that they raised in 2020. We see areas of healthcare that are facing regulatory challenges that are certainly areas that we have pursued and deployed capital into. We see areas in building products and other industries that are facing cost headwinds and logistical headwinds, and those are areas of interest. But that's going to be some subset of the market, of course. I wouldn't call that necessarily a sort of broad economic stress yet.
Yes. Thank you, Michael. And Denise Crowley, what about you? How do you see,
Sure.
or how are you navigating, let's say, opportunities today versus how you may have before COVID really began to gain stride?
Yeah, I think so. Coming into the COVID period, I think there are a couple of things that went reasonably well for us. For starters, we in our existing funds, we didn't have a tremendous amount of financial leverage, and for the most part, we had some cash on hand, so we were able to deploy that. We also had capital commitments from investors that were to be drawn, should distress occur in the market, and we were able to draw a lot of that capital actually starting on March 18th of 2020 to invest in what I would call relatively liquid, relatively more public end of the securitized product market primarily. At that time, our CLO team was also able to capitalize upon the dislocation by buying a lot of loans, via warehouses and so forth, as well as existing deals. And so, I think at that time it really was characterized by a massive sell-off in, relatively high credit quality, largely public end of the securitized product market. So that was just, in our view, a great opportunity to add risk to our portfolios at really attractive prices. And through our analyses, we felt that even in, fairly draconian outcomes, even if the pandemic had pretty bad outcomes and, clearly, multiples worse than what we actually saw in terms of economic impact, that these particular securities would likely do very, very well and would still come through, without any impairment, essentially. And so we were able to add a lot of that type of risk to our portfolios. I think as things have progressed, it's become sort of a different type of market environment. Certainly a lot of good news has been priced into the markets, and I think that's one of the big headwinds going forward. If you look at valuations on equities and high yield indices, or IG, valuations are tight, certainly from a spread perspective, from an all-in yield perspective, and on a historical basis. Having said that, I do think you're getting paid a lot for illiquidity and complexity right now. And that's partly because there are barriers to entry to some of these things. You have to have a very sort of deep and experienced staff to evaluate some of these more complex credit instruments, and you need to have certain sources of capital, the right fund structures, and so forth, to be able to hold some of these investments. So I do think liquidity and complexity are something for which you still get paid today, and therein is considerable opportunity in our view.
Okay, and Denise, let me just ask you a follow-up, given the direction you were taking. What is your macro view going forward, and how do you see it impacting your ability to position in credit?
Yeah, certainly. I think for starters, as I may have just alluded to, valuations are tight in a lot of risk assets. Certainly the on the run, sort of more liquid risk assets, from equities to IG to high yield. I think we can see that. And I think because of that, things become, sort of more challenging to navigate going forward. However, if you look at some of the, of the offsets there, I think for starters, you have a lot of cash, both from consumers and institutions, pushing into these markets. We're in a world in which real rates are negative. I think, there's been some focus, on behalf of the Fed and others, about this employment to population ratio, which has gone down. And that generally correlates pretty highly to staying in this sort of negative real rate environment, even as growth, I think, continues to rebound, right? So we do feel that it's probably too early to become too defensive. We do think that the growth outlook in the U.S. economy is still pretty strong. We do think that there is, a lot of consumer pent-up demand that continues to be the case, obviously, with $2 trillion or so of excess savings and a very low debt to disposable income ratio. Consumers are in pretty good shape. We think consumers will be measured in their deployments of that, savings. But, generally speaking, we expect the growth outlook to be pretty good. So we're not getting too defensive yet. We think there's still really good opportunities in this market where, defaults are likely to be low, I think, across consumer product as well as corporate product. we still see some pretty good, opportunities therein. And I do think that there is going to continue to be this global hunt for yield, as sort of real rates continue to be fairly negative and a lot of capital chasing it. And really the areas in which we think you're paid to take on risk is in, some of the less liquid, more complex credit markets, structured credit markets, things like subordinate CLO tranches, certainly in the resi space, in the securitized product market. We think there's some good opportunities, particularly in the more subordinate tranches of credit risk transfer deals. We think with regard to the consumer, we're really sanguine on the consumer, and there,
Okay.
we have been participating in sort of asset-backed transactions and, in sort of the first loss type pieces where we see some value, as well as, more private market type transactions where we're essentially, where we feel we're getting paid a lot to, assume a greater amount of illiquidity. So, we do think that there are some really good opportunities to be had. Clearly, the wild card is inflation. I don't think any of us know for sure how this is going to play out. Certainly inflation may, sort of go back to more normalized levels once we get through some of the supply chain issues. That's possible, certainly in the second half of next year. Or, the inflation may stay elevated for some period of time, a lot of money supply and so forth in the economy. I think we can make some pretty good arguments on both sides. And so what we try and do as portfolio managers is make sure that we're positioned reasonably well, essentially, without getting, too specific on what we think the, inflation outlook is likely to be. So,
Okay.
For us, that means really investing in these higher yielding parts of the market where we think you're getting paid. It also means managing your cross asset correlation. So, we don't want to be too beholden to any one asset class, whether it's corporates or consumer or real estate. And we do have a bias toward, floating rate exposure. We'd rather be taking fundamental credit risk right now, as opposed to, taking a lot of interest rate risk or convexity risk or things of that kind.
And Denise, before I ask Michael his opinion on this, just a quick follow-up, and that is, do you see rate hikes mid-year or toward the end of 22?
Yeah, I mean, look, I think we can talk about what's priced into the market, 2-ish rate hikes for next year, perhaps. Our view is that most likely the Fed is going to be pretty measured still with regard to rate hikes. And we don't really expect the Fed to get too hawkish here. I do think there's the chance that they sort of accelerate, the reduction of their purchases. That's clearly something that could be on the table. But, we sort of, I think we're sort of in line with the consensus there. But look, this is a market where, this is something that nobody can tell you exactly how this is going to play out. Nobody can tell you if policy errors are going to be made, fiscal or monetarily. So, I don't think you want to get too precise on this. I think you want to position yourself to withstand a little bit of volatility, on the inflation and the rates outlook.
Okay. Thank you very much, Denise. And Michael, what is your macro view going forward, and how do you see it impacting your positioning in credit?
Yeah, we try and be pretty intellectually humble in the context of, we think we're really good at making fundamental credit selection. Having a differentiated view on the macro landscape, I think, is in many respects is a different business. And so the investments we're making today, we think withstand a number of different types of economic cycles. And so I guess the first answer is, to invest in such a way that you feel somewhat protected from that type of volatility, because to Denise's point, it's very difficult to predict where rates are going, where inflation's going. I think we're generally pretty aware that we're not sure what will precipitate the next down leg to the credit cycle. And I think if history has been any guide, it's that, those are always events or outcomes that are unexpected. What I do know is because of all the headwinds that we've touched on, and because leverage levels are higher, and companies have made it through the pandemic, raising liquidity largely in the form of additional debt, that the next cycle is likely to be a lot more volatile than the one prior to it. And so I can't tell you what black swan will precipitate it, but I do think that's sort of the future outcome that we prepare for and make sure we have dry powder for. And so like that doesn't really answer like what do we think today and what we're doing. Look, as relates to how invested we are, we're probably in the middle of our most bullish and most bearish outcomes. I do think valuation in the public markets are historically elevated, and I don't think sub-investment grade credit, should be trading at sort of sub 5% yields in the long term. Doesn't strike me as historically rational. It doesn't strike me as a very good risk reward for investors. And so, that is driven by a combination of, I made a joke the other day, like the only sure investment loss I can think of is cash. And so, so that tells you all you need to know about the flow of funds into high yield and bank loans. And so I think there's a fair amount of uncertainty. I think that in the face of that uncertainty, and I think investors would be wise to consider, volatility and unexpected events creating volatility. I think there are ways to address that, and those are in credit. Keep your duration under management. Our funds, our more liquid funds, tend to, maintain a duration of less than 2, oftentimes less than 1. That's through a combination of floating rate debt, some exposure to distressed names that really have no correlation to rates whatsoever, and so forth. And so that's one answer. It's possible to say on the sort of shorter end of interest rate exposure, and the market gives us plenty of tools to do that. And the other is to understand that when markets become volatile, they also become less liquid. And as a consequence, you have to consider chasing yield in the credit markets from a longer term horizon than I think has historically been necessary. And so where we're deploying capital today in things that I described as A, largely in private markets, and B, idiosyncratic, it's important for our investors to be in structures and give them a multi-year time horizon so that they understand that these are holdings that we may have for 2, 3, 5 years in order to withstand, the type of uncertainty that's out there. One thing's for sure, I mean, in my now multi-decade career, like I think that I've seen everything, but I sort of haven't seen inflation. So what's that going to be like? And I say that with all humility. I think that's true for, most of the professional investment world. And we don't know whether it will be transient or the impacts it will have on our companies. What we do know is we can buy credit or lend money to companies that are really good companies that will make it out the other side. And if we have to support them through that cycle, we will. And if we have to restructure them through that cycle, we'll do that too.
And Michael, I just want to point out that there may be some investment professionals who are active today who do remember what inflation was like many decades ago. It's funny how maybe history doesn't repeat itself, but it certainly rhymes, as they say.
Yeah, understood. Look, I mean, I say that somewhat in jest. I mean, obviously, we think carefully about what inflation could be, but all the same, it's been a long time since that's been a daily factor that the sub-investment grade market has had to take into consideration.
Absolutely.
You can look at high yield and say, well, 5%, that's better than treasuries at 0. But what if that 5% is at a net zero real rate? Then what?
Yes.
And so there's all those things we consider, which is why I still find, what Denise and we target as being reasonably attractive, which are maybe less liquid opportunities, but with much higher rates of return, where the risk you're taking is really more credit risk than macro risk.
Okay.
In structures that can sustain the time horizons needed to exploit those.
Okay.
And that won't be for every investor, but in today's cycle, I think it's the best risk reward.
Michael, thank you. And Denise, given the direction that Michael took the question, I want to give you an opportunity to weigh in on opportunities that you find most of interest right now in the alternative and structured credit markets. I just want to give you a crack at that.
Yeah, thanks. So I think there's some real pockets of opportunity today. notwithstanding the tightness in some of the broader markets. And, I'll start with the CLO market. I think it's been a really interesting market this year. So on the one hand, you've had CLO portfolios in general become much, much higher quality this year as compared to last year, even last year pre-pandemic, right? So if you look at the ratio of triple Cs in portfolios today, the dollar price of loans in portfolios today, the weighted average rating factors, essentially all of the sort of quality metrics of these CLO portfolios, by and large, with some exception, but by and large, they've improved markedly. But if you look at the broader picture, supply has been large. So you've had a tremendous amount of issuance this year in CLOs. The top part of the capital structure, has actually come in quite a bit. So, the pricing and the most senior liabilities has come in quite a bit. It's not, too wide anymore. But I think that supply pressure has left the bottom parts of these capital structures as being pretty wide, certainly on a historical basis. I mean, certainly
Yes.
if you look at the funding gap, as we like to call it, some people call it the arbitrage, right? Essentially the difference between where the leveraged loan assets are and the liabilities, and essentially what's left over for the equity. That's pretty wide right now on a historical basis. And it's in large part due to this supply, because as we said, the quality of a lot of these deals has gotten much better. So, when we look at CLO equity, we think it's actually a really interesting asset class. For starters, there's really no interest rate sensitivity to this product. It's all floating rate assets, floating rate liabilities. I'll get to the LIBOR SOFR issue in a second, but essentially you have this very high carry. I would say pretty high carry in this market. I think on average, deals are carrying, call it mid to high teens in terms of their cash on cash right now. That's not necessarily indicative of their yield, just to be clear, but that's their cash on cash right now. And if you kind of look at the expected default profiles of a lot of these underlying portfolios, we are finding, granted very selectively, but very interesting opportunities in CLO equity today. I do think actually that this market will continue to be interesting, the CLO equity market. You do need to be selective. I do think there is going to be some potential for higher volatility, as we go through this LIBOR SOFR transitioning, where essentially the loans themselves have just begun the process of switching to SOFR, and deals themselves are going to start to begin that process, I think, in earnest next year. You will have some volatility in there. I think the better managers will be able to capitalize on some dislocations to actually improve the credit quality of the portfolio at good prices. So, I think you have to be selective. Even in this very low default environment, there is, potential for idiosyncratic defaults here and there. So we evaluate every single CLO portfolio. We look at it from a fundamental credit perspective. We also look at it from a more technical perspective. So we'll price pools relative to the broad liquid synthetic market, like the broad, market for high yield and IG corporate risk synthetically. And we'll sort of, come up with levels that we think are appropriate based on those underlying portfolios. So it's very much a, credit specific investment process. I would not broadly buy the whole market, but we see some tremendously good opportunities there. And similarly, for a lot, I would say for some similar reasons, we're seeing some select opportunities in sort of real estate securitizations, asset-backed lending facilities, and the like. I would say, on the aspect side, just to be clear, we're very sanguine on the consumer. So, we think that the consumer is very well positioned with a lot of savings and low debt, and they're going to be fairly judicious about how they spend that. So we think consumers are, generally in good shape. But we also think that a lot of the products sort of geared to consumers, whether that's consumer installment loans, student loans, autos, credit cards, et cetera, we do think that there is essentially, need for private capital, for a lot of these loans and for a lot of these companies. And, we've been able to find, opportunities that we think are pretty interesting therein.
Okay.
And on the real estate side, I would say it tends to be more supply and demand driven. We're pretty sanguine, actually, both on, home prices moderating from here, but remaining reasonably okay. And on the commercial side, we think things will continue to to reflate on the commercial real estate pricing side. And there we're sort of opportunistic in those markets, depending on, technicals primarily, as, supply has come in larger than expected, or structural changes have led to, some dislocations. We found some, opportunities there, and selectively, of course.
Okay. Denise, thank you. And Michael, let me ask you, what sectors and geographies are you finding most attractive right now?
We're a developed economy investor. That means mostly North America and Western Europe. And even within Western Europe, as a credit investor, we're pretty careful about jurisdictional legal risk. And so that might cause us to be comfortable with, Germany and the UK and maybe the Netherlands, and less excited about Italy and Spain, just as for example, or even Eastern Europe. So that's geographically speaking. Europe has not really had the same recovery that the US has. And so we have found a distressed opportunity that we think very highly of, and that our material holdings for Beach Point in this type of cycle. And so that's maybe taken a little more airtime than it might historically. Whereas in the US, as everyone knows, we're looking at pretty low default rates. So in public markets, there's not, been a ton of opportunity that's been all that persuasive. Maybe healthcare, where regulatory driven stress is maybe an outlier there. And we have deployed some capital into the healthcare sector.
Okay.
In private markets and more of the idiosyncratic opportunities I was describing, I'd love to say there's a specific industry focus, but most of those are relationship driven and are unique situations. But I'll give you some examples of those, just so the
Please.
Audience has a sort of example of where you might find 10, 15, 20% opportunities when high yields at 5. Sounds crazy, but as I say,
we're taking notes.
Many of those. We continue to find opportunity in the regional gaming market.
Okay.
Both for facilities that were over leveraged, and also for new facilities that will have huge competitive advantages, but there's not a ton of financing for new casinos in this type of environment in regional markets. And so that's been a huge area of opportunity for us. We continue to provide financing to leisure companies. One interesting sort of perspective to have on leisure is, while people are booking trips and airfare and hotels in sort of record volumes today, that creates pretty material working capital drains for leisure companies. And those are not working capital needs that those companies were necessarily preparing for or have capital for today. And so there's a bunch of sort of transition type of capital we can provide to those types of industries as they look to beef up the working capital they need to deliver services that they've collected deposits and money for earlier in the cycle. So that's a second. Within real estate, this is outside of gaming. It's still really difficult to find money to build hotels, no matter how well positioned or how unique a proposition they may be. Those are interesting opportunities for us. And then, I would say individuals and sort of non-large fund financial sponsors also may have great investments, but can find themselves less liquid. And so we're finding opportunities to back management teams and people who may have, a ton of net worth, but not a ton of liquidity, deploying capital into sectors they're expert in. And so you can think of those as sort of private market margin loans. Have been a big source of opportunity. Lastly, this is sort of a new one for us, but is a unique one for the environment. Many people on this call will have seen the huge quantity of SPACs that have been listed, and we're not typically buyers of that type of public equity. However, when those SPACs go to de-SPAC and to merge, oftentimes the amount of cash they will have after shareholder redemptions to close their mergers is a bit uncertain. And so we're seeing an increasing amount of opportunity providing, think of it as bridge capital to SPACs looking to consummate those mergers to reduce that uncertainty.
And Michael, what size are those loans typically, or is there a range that you've seen?
I mean, we've seen opportunities as low as 20 million and as much as $500 million. It really
Okay.
depends on the size of the underlying SPAC target.
Very
But that is a topical opportunity. It is not a liquid opportunity.
Sure.
It requires investors willing to sort of play through the performance of the underlying company in most cases. But for that, you can be well paid. And oftentimes we're looking at opportunities where we get warrants or some equity upside to the extent that
Yes.
the new public equity performs. And
Good,
so
good.
that's sort of a new opportunity set that we're spending a fair amount of time on.
Michael, thank you. And Denise, before we get into ESG, I do want to get your reaction to sectors and geographies that you might have, let's say, a special interest at this point, and also Michael's comment about the 10 percentage plus opportunities. So if you would, please tell us about sectors and geographies first.
Yeah, so I think geographies were mostly focused on the US and Europe, with
Okay.
big emphasis being on the US, so purely developed markets as well.
Yes.
And, in terms of sectors, I think, we've really tried to be fairly diverse in our underlying sector exposures. So, through structured product primarily, we have exposure to the consumer, we have exposure to commercial real estate, we have exposure to residential real estate, and corporates, mostly corporate loans, some bonds as well. So, fairly diversified in terms of our look-through exposures, and try and manage our cross-asset correlations accordingly, and really, build some diversity into the portfolios by having relatively uncorrelated risks, at least in some cases. So that's sort of where our focus is. It's really across the board in structured credit in the US. And in terms of returns, yeah, look, I think many of the aforementioned things that I mentioned are double-digit, return
Opportunities.
type opportunities, at least, as we expect for our, sort of base case loss adjusted assumptions, right? So, I do think that you can get, pretty well rewarded for, complexity and illiquidity, as I mentioned. And I think that's certainly true. If you have the expertise to invest in things like CLO equity, residuals or first loss pieces, and some of the consumer ABS products in which, we've found some interesting things to do, as well as some of the asset-backed lending facilities, and a little bit on the commercial and real estate side, generally, again, more subordinate type risk. So first loss type risk, or, you could be buying loans and financing them. And I think these kinds of things, as well as, some mezzanine type positions could, potentially deliver what we think are really good returns per unit of risk. And I think potentially double-digit type returns. So that's what we're mainly focused on. And again, trying to really take credit risk and understand and evaluate that credit risk, and really not looking to take other types of risk, like duration risk, like convexity risk. These are things that we're probably, looking to have relatively low exposure to, and certainly our portfolios reflect that.
Okay. And Denise, thank you. And I'd like to pivot now to a topic I think that many people have great interest in these days, and that is ESG. And so, Denise, let me ask you, what considerations, what ESG considerations are impacting the credit markets today?
Yeah, so I think, for us at Zeiss Group, this has become, very, very much integrated into our credit process. And so as a signatory to the UNPRI, we believe in the Sustainable Development Goals set forth by the UNPRI standards. We have a pretty, I would say, robust effort to help us essentially evaluate and integrate ESG considerations into all of the credit investments that we make, right? And so we have a team of 5 who are dedicated to evaluating ESG considerations for all of our investments. And so, those five, that team of five reports directly to our president, Dan Curry, who's also our chief ESG integration officer. So this is something that we've thought a lot about and, have really sort of incorporated, into our processes. And essentially, what our analysts are doing is, they're checking company filings. They're of course using sort of AI and machine learning to, scrape
Okay.
sources for information. But really what we're trying to do is, we've come up with our own methodology, for doing ESG research. We're using SASB's materiality framework as a guidance, for identifying essentially financially material risks as it comes through from the ESG side. I mean, essentially, we think that companies that are, more, let's say, well positioned for a lower carbon future, companies that are well governed and, have sort of reasonably, socially responsible practices, are companies that are likely to do better. And,
Yes.
This is really sort of part of our thesis and methodology. And I think, from our side, we think that, doing a good job in terms of ESG integration and research and coming up with some meaningful, standards around qualifying various investments in various companies, is really important, really a part of what we do. And, it's something that I think investors have become much more interested in. Certainly if you look at the kinds of questionnaires that are sent by investors, there's a lot more focus on ESG considerations today. And, I think we've really tried to build out that framework, to support all of that which we do.
Excellent. Thank you, Denise. Michael, do you have any thoughts on ESG in our remaining 8 minutes here? I know we have a couple more topics to cover.
Yeah, that's fine. Maybe I'll address it just really briefly in a, sort of practical way, which is like sitting at the portfolio management level, for less liquid strategies. How has that impacted investment decisions? And I would say there's two ways. First off, there are industries that I think were previously touchable that today are just not. Examples of that would be things related to, for example, private prisons. Maybe that's an easy one for me to talk about, but there are industries that will see less access to capital because investors like us who manage money for public pension plans and ESG sensitive investors are just not going to participate. So that's one. More importantly, I see real impacts on the more proactive side, meaning companies that we receive feedback from our clients are excited that we're investing in because they are industry leading, forward thinking, ESG friendly companies. For example, we have a building materials company that is involved in road construction, whose technology yields for their product yields a carbon footprint 40% below more traditional road construction methods. And that will yield a valuation and a cost of capital for them far, far more attractive than an investor base who was less sensitive. So I think on the more positive side, you'll see valuations and cost of capital begin to reflect positively for those companies who are contributing in that way to our portfolio.
Michael, thank you. And while you have the floor, I'd like to get your view on the yield alpha return potential between private and public markets.
So really what we're talking about, I think I'll answer it a little bit differently, is like, what are we getting compensated these days for illiquidity? And I'll give you a fun example, which is we were one of the primary creditors to a company called MoneyGram. They're in the money transfer business. They compete with Western Union.
Yes.
We made a private loan to them that was a double-digit yielding piece of paper, and we received some warrants. And so you can think of that as a mid to high teens rate of return. We held that paper for 2 years, and we were refinanced with 5.5% bonds. I don't think in the history of my career, my investment has been refinanced at 800 basis points thinner spread.
Yes.
I'm used to being outcompeted a little bit, but not through the public markets by that much. And that's emblematic of the difference. We have seen plenty of environments where the opposite's been true, where I'll see, a private second lien piece of paper of marginal credit quality, being offered to me at, I don't know, think of it as 8-9%. Maybe in the environment, it sort of feels okay, but you can probably buy semi-liquid second lien public credit for the same yield. And you really you were paying for the access. You were not getting paid for the illiquidity. And today it's the exact opposite. The things
Yes.
we're doing that are bespoke, we're getting paid, in my opinion, hundreds of basis points more than the public market equivalent. And that's, in my opinion, when we start seeing 300, 400, 500 basis points of premium for that liquidity, that makes sense. And it's something,
Yes.
particularly with call protection and, an ability to compound that over several years, is a premium that we find sufficiently attractive to justify that illiquidity for funds and accounts that are structured to accommodate that.
Yes. And thank you, Michael. And Denise, any thoughts on this?
Yeah, so I would say, we have had somewhat similar experience. Certainly if we look at things that we've done sort of in private, what I would call sort of more asset-backed lending type facilities, for example, where, we've been able to take on, tranched risk. If we look at sort of the commensurate cost of, similar tranched risk, similar collateral and so forth in the public markets, generally speaking, it's been several hundred basis points, right? So you're talking about mezzanine type risk collateralized by a pool of loans that we've diligenced, that we feel, pretty good about. And we've seen those very same pools of loans refinance in the public market hundreds of basis points tighter for commensurate level risk. So, sort of similar attachment points, if you will. And so I do think that we have, we've seen a lot of that, especially on the consumer side. I do think, though, what remains interesting is that there is still a need for, what I would call more private type arrangements or private credit type arrangements or facilities, for a lot of the some really, really good companies, consumer finance companies that, have a good track record. We really like their credit process. We like, essentially their performance. But yet for a number of reasons, maybe it's a new team, they've started a new company, they still need to rely on that private market financing. And certainly when you go through periods of volatility and the public markets shut down, periodically, they want to maintain access to that. So, notwithstanding the fact that the public markets have been tight and have been so robust, there remains a need for private capital, certainly on the consumer side. There may be other segments where the market's, a little bit more, there are a lot more investors, but certainly as we, see it as it pertains to consumer credit, there is opportunity, I think, to
Yes.
continue to find interesting opportunities there.
And so in the remaining time that we have, about a minute and a half, Denise, I'm going to start with you to talk about some of the risks to credit on the horizon.
Yeah, well, I think certainly, of course, there's always risks that are hard to fathom. But I think clearly, if we look at inflation,
Yes.
It's a question mark, right? If we really do get persistently high inflation that's growing faster than, say, net operating income as it pertains to, commercial real estate. And ultimately on the corporate side, companies, they're pretty well termed out right now in terms of their financing, and they have a lot of cash on hand, but at some point, they will refinance. And so you could start to get into some problems. And I think certainly in the more liquid markets, like, equities, IG, high yield, et cetera, inflation and the specter of, higher
Yes.
rates, consistently higher rates could derail markets ultimately. We don't see
Yes.
that imminently. We don't think that that's a very, near term significant risk, but, we'll see how that plays out. We'll see if there are any policy errors or mistakes made and how that influences, the macro picture. But those are some of the areas where I think one could.
Thank you. Thank you
find
very much. And Michael, what about you? What are some of the risks to credit on the horizon? And also give us a sense as to what the next distress cycle might look like, and see if we can do this pretty quickly. Thank you.
Yeah, sure. Look at, touching on some of my points before, the sub-investment grade universe has had access through the pandemic, but that's largely been through debt. And that will leave this universe more leveraged than it has been going into the next cycle. What precipitates that? I sort of think that's the interesting part of our business. It's really tough to predict what one act or outcome will give rise to that cycle. Normally, whatever we might say on the call today, it's going to be something else. I do know that as a result of the sort of state of the sub-IG universe, that cycle will be
Yes.
more volatile, higher severities, and hopefully for investors like us, more opportunity.
Terrific. And unfortunately, folks, we've run out of time. And I do want to thank Denise Crowley of Zeiss Capital and Michael Haynes of Beach Point. I mean, this was a jam-packed session, folks. I really appreciate it. And I know our audience does. So, and I hope to have you back in the future. I also want to encourage our audience to reach out to both Denise and to Michael. You see their contact information on the screen. And I also want to remind everyone of the holiday event that we have on December 1st and encourage everyone to go to the website and to sign up for it as soon as possible. As I said, spots are limited. But again, Denise Crowley of Zeiss Capital and Michael Haynes of Beach Point Capital, thank you so much for your time and for a job extremely well done.